So the government gets paid more money and you keep less money. In reality, that's how it's going to play out.
It is, yes.
If that's the case, what will people do? So welcome to the Teach Me About Property podcast. We're here today joining you with Anita Dhakal from ARK Accounting. How are you, Anita?
Good, thank you. How are you?
Yeah, very good. I'm excited because today we're going to be talking about the changes that have just come in through the budget.
I know, yeah.
How it kind of impacts everyone and what we see as the opportunities. And we're just going to delve into that. I'm having so many conversations.
Right.
I'm sure you are as well.
Correct, yeah.
Yeah, so we'll delve into that a little bit. We'll learn a little bit about you. Obviously, your relationship with Teach Me About Property.
Yeah.
But I'm super excited. I'm super excited for us to have this conversation today.
Same here. Thank you, Massey. Thank you for having me on your show. And it's a great pleasure for me.
Okay, cool. Let's dive in. So talk to me about the budget changes. What are the three main areas in the budget changes that the government's put in place?
Yeah, so the biggest one probably is negative gearing. A lot of people have been talking about it. You probably heard a lot in Insta and TikTok and everywhere, news all over it. So that's one of the biggest changes. Second change is the capital gain tax.
Yep.
Again, they are scrapping out the 50% discount and they are introducing this cost-based indexation. It used to be there before, 1999, in between 1985 to 99. But again, they are reintroducing this because 50% CGT discount, they are saying, is not reflecting the true inflation. Either it's overcompensating or undercompensating, right? So that's the reason why they are introducing this. And the third probably is, discretionary trust, which they are introducing 30% minimum tax on it. So yeah, a lot of changes are happening in this. And if we look at the personal tax rate, it's going to go down a little bit, 15% for earners who are earning like 18,200 to 45,000.
Cool. So there's a whole bunch of changes. We'll do a deep dive on those and we'll unpack them. We'll kind of go one by one. So why don't we start with negative gearing?
Yeah.
So what's the biggest changes with negative gearing? What does it look like now?
I know a lot of fear has been seen in investors. I had a couple of chats with my friends and they are very worried about, what's going to happen. Some people who are thinking about, buying investment properties towards the later years, now they are changing their mind. They are reconsidering the plan.
Yep.
Should they rather be investing somewhere else? Because negative gearing, it's like if you're earning like a really good pay, right? It's a very good way to reduce your tax.
In your opinion, what's a really good pay?
If I say 200,000, right, that's a good pay.
Yep.
And if you have like a negatively geared property, which you spend 20,000 out of your pocket, then easily you're saving around 9,600 in that, right?
Yep.
Is a tax benefit. But now if the government is scrapping that out, then for the short-term benefit, you don't see anything. Long-term, probably there is, because that will eventually get carried forward and it will be offset against future capital gains or future rental incomes. But for the short-term
period, just give me a little bit of clarity. What is the change? What's the change now? What's changed?
You're not getting the negative, so it's not going to offset against your taxable income.
So
against
when
salaries
does
and
the
wages.
negative gearing still apply?
If you buy brand new builds, then it will apply. But if you go ahead and buy new established properties, you're not getting it.
Okay, cool.
Yeah.
And so, talk to me a little bit about the capital gains tax. What's the change there?
Okay, so there's a massive change in it. So currently, if you make a profit of, let's say, 500,000, automatically, if you hold the property for more than 12 months, then 50% discount you automatically get. So reducing the taxable capital gain to 250,000, right? And if you're in a higher tax bracket, again, if your income is 200,000 and you made 250,000 of capital gain, so you will pay around 47% tax in it, including 2% of medical LBI. But going forward from 1st of July 2027, what will happen is on 1st of July you will have to revalue the cost base of your house, and then after that it's just the cost-based indexation. So every year, as per the inflation, your cost base will be recalculated, and you will have to pay the tax on the real inflation gain.
Okay, so have you run any numbers as an example
Yeah.
or before and after? What does that look like? Talk us through that.
So let's say you're a property investor. So before the proposed reform, take the top number, same salary, 200,000. Your sales price remains same, $1.5 million. So original cost base when you purchase the property, it was 800,000. So with the
That's a 700,000 gain?
Correct. Yeah,
Yep.
it's a 700,000 capital gain. So with the 50% CGT discount method, your 350,000 will be taxed, right? Because the 350,000 is discounted. So from that point, you have an estimated tax payable of 164,500 if you're in a tax bracket.
Okay, so I'll say that again for everyone. So you've got a couple that's on $200,000 a year.
Yeah, a person. Yeah.
So individual, right?
Yeah.
They own it. They've got an investment property. They bought it for 800,000.
Correct. Yes.
They sold it for 1.5 million.
Mm-hmm.
They've got a gain of $700,000.
Yes.
Right.
Yeah.
In the old world,
Correct.
they would get a 50% discount on that. So there's, instead of 700,000, it'd be 350,000.
Yes.
And on that 350,000, they're then taxed at their marginal rate.
Yes, that's
right?
correct.
So
yes.
if their marginal rate, because they're on 200,000, is 47%.
Yeah.
Right? Mm-hmm. So that would give you a CGT amount of, what was that number again?
164,500.
164,000. Okay, cool. So fast forward to like when the changes come in, what would that look like now?
So what will happen is, again, 1st of July, after you do the cost-based indexation, right? So let's say in 6 years' time, with 4% of inflation, your cost base will increase to 1,012,255.
Yep.
So the capital gain there is 487,745.
And so just to run the numbers again, you own a property, you've still bought it for 700,000, you're still selling it for 1.5 million. You've had it for 6 years, and the inflation gets your total cost base to
1,012,255
plus some change.
Yes.
Right?
Yeah.
So that means you're taxed on
87,000.
487,000.
Yeah, I
and
know.
that 487 is calculated at the marginal rate.
Yeah, it'll be calculated at the marginal rate. But the thing here is, if you have any negatively geared properties, right?
Yep.
Imagine that it was a negatively geared. Every year you're putting like 10,000 to it. So that will also get deducted from there. So at the end, your taxable capital gain will, let's say it was 60,000 that it was negatively geared during that period, right? So the new taxable capital gain will change to 547,745.
So how much do they have to pay?
257,000.
So 257 versus
64.
160. So it's almost 100 grand, right?
Correct. Yeah.
So almost $100,000 difference.
So that's what you're losing with the new system. Yeah.
So the government gets paid more money, and you keep less money.
Yes. Yeah.
In reality, that's how it's going to play out.
It is. Yes.
So if that's the case, what will people do? So if I already own property.
So if you already own property, you might be holding back on those properties because, if you sell it, then you're not getting the negatively geared. If you're thinking of selling, okay, yeah, I'll sell this property and go into a new one, you're forgetting about the negatively geared amount if you're going and purchasing the established properties, right?
Yeah.
And then you're not also getting 50% discount, right? Unless you choose to go with a brand new one where you get the benefit of 50% capital gain tax discount plus the negative gearing.
Cool. Okay, and then the last one, trust.
Yeah, so a lot of families that I speak to, the only reason why they establish this family trust is because of the income splitting so that they can distribute income to lower taxable individuals, right?
Yep.
People with low income.
So husband and wife.
Yeah, husband
Hubby
and
works, wife doesn't.
Correct.
Or she works, he's got a good paying job, 200 plus, and she has a token role where she might be on 40, 50 grand a year.
Yeah, correct. Yeah. In those cases, so the income would distribute it to wife, right?
Yeah.
Because she has a lower income. So the tax would pay less tax. As a family, they will pay less tax. But then going forward, the trustee will have to pay 30% flat rate on the trust income, which is eliminating this income splitting benefit. But then again, saying that, if you're looking for asset protection and succession planning, so it's still there.
Yeah, so are trusts still relevant?
Yeah, so that's a lot of question. It depends on what do you need
Okay,
trust
better
for.
question then. who will trust be more relevant to now in the future?
I think people with high net worth, if they want to have like intergenerational wealth saved, or like I said, asset protection and succession planning, so it'll be relevant for them. But if people are looking to just use it as an income splitting method, then definitely it's not worth it.
Yeah. Plus, so I've seen a lot of companies they'll promote different structures, and they kind of over engineer really early.
Yeah.
So the people might only own one property.
Exactly.
One investment property, and they got this really
it's not beneficial,
dense structure, and it's like, why do you need that?
Yeah, exactly.
So that'll disappear, right? If
That
you've
will.
just got mum and dad with a single owner-occupier home and one investment property, they probably wouldn't get into the function of a trust structure.
No, you don't want to go into something complex. You just want to be like, even under personal tax rate, it's fine.
Yeah.
It's not going to impact that much. Even with 2-3 properties, you can still have it under, your personal name.
So what do you reckon? 5+ is probably the entry
Probably,
point.
yeah, 5+. Yeah.
5+, which would net, that person would then probably have about $5 million in assets.
Yeah.
And so then they're starting to worry about, what happens in the future.
Yeah.
What does that look like?
Yeah.
Asset protection comes
Correct.
a lot more relevant. But the trick is you got to put the structure in place at the point of acquisition.
Yeah. So I'm also hearing from people who are thinking of, like, should I set up a discretionary trust? I already have 3 properties under me and my wife, right? So what do you suggest? And I'm like, probably it's a good idea after 3-4 properties, you go and set up. Otherwise, if you want to transfer these properties back to the trust, then again, you'll have
duty.
to, treat duties, Yeah,
and duty on $5 million worth of property is not fun.
I know, right?
Explain to me what the impact is for first homeowners. So the changes have just happened. I'm a first homeowner. I'm freaking out. I don't understand what's really happened. All I care about is, what does that mean for me?
Well, if you think from the government's perspective, this is what they are saying, right? Because they want to have no competition with the investors.
Yep.
They want more buyers to enter the market and have less competition with the existing investors. So that's why, these existing properties will become more affordable.
So from
works.
a tax perspective, any impacts or changes to a first homeowner?
No, because
So
they don't
nothing
have
changes?
any. Yes,
Nothing changes.
no changes to the first home buyers. Yeah.
Okay, so from a first home buyer, if you're a first home buyer and you're watching this, what the government did in the May budget has no impact or bearing on you from a tax perspective.
Correct.